Information presented is for educational purposes only, and views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate. Information does not intend to make an offer, recommendation, or solicitation for the sale or purchase of any securities.
Welcome, everyone. I'm Jason Nickerson, President and Chief Operating Officer at John G. Ullman Associates, and this is Meeting the Market. This is a monthly series designed to keep you informed on the economic news, market developments, and trends shaping today's investment landscape. Each episode breaks down recent market activity, highlights key events to watch, and discuss what may lie ahead. With nearly 30 years in the financial services industry, my goal is simple: to provide clear, timely, and unbiased insights on what matters most so you can stay informed and confident in a constantly evolving market. So with that, let's meet the market. Start with macro moments. Inflation heats up, Fed pivots tone, and geopolitics cool. At least it did for a minute. This month's macro backdrop is defined by hotter than expected inflation, a more assertive Federal Reserve, and a geopolitical landscape that has proven to continue to be volatile. Inflation surprised to the upside. After months of progress, we saw a broad-based reacceleration. Services inflation remained sticky, shelter costs ticked higher, and categories that had been easing, like auto insurance and medical services, turned higher again. That single data point forced markets to rethink the entire rate cut timeline. And then came the Fed. With Kevin Warsh now leading the Federal Reserve, the tone of the most recent FOMC meeting was unmistakably firmer. Warsh made it clear that rate cuts are not imminent, and he explicitly left the door open to raising rates if inflation fails to cool. That's a meaningful shift from the cuts eventually narrative that dominated the first quarter. Warsh also signaled a change in communication strategy. Short horizon, data-dependent guidance instead of long-range projections, that alone tightened financial conditions without a single policy move. Bond markets reacted immediately. 2- and 5-year bond yields jumped, reflecting the risk of a longer, high-rate environment, and the small real possibility of another rate hike. 10-year yields moved up more modestly, suggesting long-term inflation expectations remain anchored. Equities have been volatile. Growth names, especially those priced for perfection, saw the sharpest pullbacks recently as discount rate expectations reset. Value and quality have held up a bit better, but volatility has risen across the board for sure. And then in the middle of all of this, we got a short-term geopolitical surprise with a ceasefire and perhaps a peace framework with Iran, which was quickly undone after just a couple of weeks. Months of escalation risks, the announcement of a ceasefire, and a structured peace deal potentially reduced geopolitical risk premium that had been quietly embedded in energy markets and defense stocks. Oil prices eased temporarily on the news, shipping route risk declined, and markets broadly welcomed the de-escalation. It doesn't remove all certainty when things like this happen, but meaningfully can lower the tail risk scenarios that had been hanging over global markets. And just like that, we got reversal, and now we are back in volatile situation. The bottom line is the market is adjusting to hotter than expected inflation, a more forceful Fed, and a geopolitical backdrop that just became volatile again. Now to big name companies and other current headlines. NVIDIA continues to anchor the AI infrastructure story, and its influence grows. Jensen Huang, the CEO of NVIDIA, seems to have the golden touch of sorts. When announcing partnerships or investments with other companies, it seems to influence the stock price for those companies, showing the reach and influence NVIDIA has on the market. Overall demand remains strong, but investors are watching for signs of normalization as supply catches up. The next product cycle will determine whether margins stay elevated. Apple is back in focus after unveiling deeper AI integration across its ecosystem. This is a long-term monetization story, not a quick revenue bump, but it's a meaningful pivot. Other names like Microsoft, Amazon, and Google remain the backbone of enterprise AI. Cloud spending is reaccelerating, and each company is positioning itself as the platform where AI actually gets deployed. In the financial sector, they're navigating a more complex environment. Large banks are benefiting from stable credit conditions and strong fee income. Regionals remain under pressure from commercial real estate exposures. Energy and industrials reacted immediately to the short-term Iran ceasefire announcement. Oil prices eased a bit, volatility declined, and companies in the Middle East exposure saw a modest relief rally. Defense names, which had been pricing in elevated global geopolitical tension, saw a slight pullback as risk premiums normalized, but now a lot of those movements are undone. And then we have the main headline of the month in individual stock names, and that's the SpaceX IPO. After years of anticipation, SpaceX finally came to market, and in the first few days of trading, lived up to the hype. The stock opened very strong with heavy demand from both institutions and retail investors. Shares pushed higher in early trading as investors priced in SpaceX's dominant position in commercial launch, satellite broadband, and global space infrastructure. But after the initial surge, the stock settled into a more measured trading range, a sign that the market is trying to balance long-term potential with near-term valuation discipline. And that is healthy. It tells us investors that are enthusiastic, but not so blindly. The IPO also had a broader impact. It boosted sentiment across the innovation complex. It lifted related aerospace names and signaled that the IPO market may finally be reopening for high-quality companies. It's not just a company story, it's a market confidence story. And finally, let's look ahead. The next 30 to 45 days will be shaped by inflation, Fed, and earnings. Whether the peace deal holds or comes back or never comes back, these will be the main topics to pay attention to. First, let's talk about inflation. Markets will react heavily to every data point. A cooler print could ease pressure, but another hot reading in inflation could push yields even higher and reignite talk of potential hike. The Fed's communication strategy will be important, as Warsh has made it clear that the Fed will not provide long-term range guidance. Expect shorter, sharper messaging and more market volatility around speeches and press conferences. Earnings season will come upon us shortly. Companies will need to show that AI investments are translating into real productivity gains. Margin commentary will be critical. And finally, geopolitics. Will we get a ceasefire and peace framework, or are we in a long-term conflict? These are items to pay attention to. If we do get a peace deal, energy markets could calm through the summer. If we continue to falter and head back towards a much stronger conflict, volatility returns and energy prices go higher. Now, what this could mean for you, this month is about positioning for a market that's repricing risk and not panicking about it. It's one of those moments where the market is telling you exactly what it values: clarity, cash flow, resilience. With inflation heating back up and the Fed signaling a tougher stance, the environment has shifted, and your portfolio should reflect that shift. First, higher yields change math. With short and intermediate term yields moving higher, high-quality fixed income may be becoming a bit more attractive again. Investors are finally being compensated for patience. This isn't about timing the Fed, it's about taking advantage of yields that are meaningfully better than they were 12 to 18 months ago. Second, equity leadership is narrowing. The companies holding up the best right now are the ones with real earnings, real margins, and real balance sheet strength. In an environment where discount rates are rising, story stocks struggle and fundamentals matter more. This may be a moment to lean into quality, not chase momentum. Third, geopolitical risk just eased for a short period of time, and that did matter. The Iran ceasefire and peace deal framework we saw reduced a biggest global tail risk. And that's why we saw oil prices ease and volatility come down temporarily. Now, for investors, this means energy shock risk that had been hanging over markets had softened. It doesn't eliminate uncertainty, as now we see that the conflict potentially heating back up. It gives portfolios a little breathing room when it calms down, but when it heats back up, we need to be mindful. Fourth, innovation is alive and well, but needs discipline. The SpaceX IPO is a reminder that the innovation engine in the US is still running hot, but the way the stock traded, strong open, then rational, settling in, tells us something important. Investors are excited, but they're not abandoning valuation discipline. And that's healthy. It means the market's willing to reward breakthrough companies, but not at any price. And fifth, for this moment, This is a moment for balance, not bravado. With inflation reaccelerating and the Fed more hawkish, portfolios benefit from a mix of quality equities, high quality bonds, selective exposure to innovation, and a measured approach to risk. The message for our clients and some of our listeners this month may be just as simple as the environment has changed, but opportunity hasn't. This is a time to be intentional, not reactive. It's a time to position, not try to predict, and a time to let fundamentals, not headlines, drive your decisions. And with that, thanks for joining me for this edition of Meeting the Market. I'm Jason Nickerson, and I'll see you next time.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.